Avoid these like the plague. What's good, everyone? I am your student investor here to help you understand the basics of investing. Okay, I was being a little dramatic in the intro. Mistakes are inevitable. I've made all these mistakes in the last year, honestly. Making mistakes is proof that you're trying. So if you made these mistakes, it's okay, as long as you learn from them. Mistake number 1, letting your emotions get in the way. When emotions are high, logic is low. We should be trying to avoid emotional investing at all costs. Emotional investing could lead to you impulse selling stocks because of quick drops or rises in the market. Or it could lead to impulse buying the latest and greatest hot stock because you saw someone in the media make a lot of money from it. You don't want to get too caught up in the media hype or fear when it comes to investing. One of the best ways to avoid emotional investing is to first understand why you're getting emotional, acknowledge it. Ask yourself, am I about to make this decision because of a price drop or because of the actual performance of the company? Understanding the company and being confident that this company is still going to be around and even bigger in 10 and 15 years is another good way to avoid emotional investing. I'll end with this quote from the great Warren Buffett. If you cannot control your emotions, you cannot control your money. Mistake 2, not researching. This ties in with the first mistake because understanding the company and risk involved can mitigate a great deal of the emotion associated with investing. Researching stocks before investing can help you avoid huge losses. You don't want to buy a company stock that's one bad season away from bankruptcy. This research doesn't have to be extensive. It can be as little as just understanding the company, the financial health of the company, how many assets, debts does it have. When researching companies, you can look through their balance sheet, income statements, and cash flow statement. You can also look at the company news and the company leadership. Yahoo Finance is a good website to use when researching companies. Mistake 3. Failing to diversify. Diversification is the key to successful investing. Investor portfolios should never be over-concentrated in one particular business or market sector. You don't want to put all your eggs in one basket. Let's say if your stock portfolio only has real estate stocks in it. If some bad news about real estate comes out or inflation rises, all your stocks could get hammered, then boom, your portfolio's value is cut in half because you were, over concentrated in one sector. This is probably one of my biggest problems now. So understand it's important to have exposure in all major spaces. Spread the wealth. One of the best ways to easily and quickly diversify your portfolio is with exchange traded funds or ETF. An ETF is a basket of stocks themed around a specific sector or index. They can be bought and sold on a stock exchange in the same way as a regular stock can. For example, the Vanguard S&P 500 ETF, ticker symbol VOO, tracks the S&P 500 index, owning all of the equities within the S&P 500. The S&P 500 is the 500 leading U.S. publicly traded companies. Owning this ETF or an ETF like it instantly gives you diversification. If you like this video, make sure you hit the thumbs up and comment down below if you made any of these mistakes.